if you run, manage, or even audit a non-profit organization, aka an NGO in India, the legal framework you've been navigating for decades has just gone through a massive statutory reset. The Income Tax Act 2025 has completely rewritten the rulebook, throwing out scattered provisions and introducing a unified legal identity, the Registered Non-Profit Organization RNPO. Today, we are diving deep to give you a blueprint of the new regime from how the law now defines an NPO right down to the three separate income baskets you must use to survive an audit. Let's start at the very beginning. What actually qualifies as an NPO under the new law? Any trust, society, Section 8 company, or institutions like university, college, hospital, etc., established for religious or charitable purposes or for both in India for the benefit of general public. Now, religious purpose, we understand it easily. It's about practice of one's religion or place of worship. Now, what is a charitable purpose? It includes seven pillars. Now, remember the stress here is on the word includes. It is an inclusive, not an exhaustive definition, meaning it can include other purposes as well. So, what are these seven pillars? 1. Relief of the poor, that is, providing free food like Akshay Patra Foundation providing midday meals. 2. Education, setting up schools, colleges, or universities charging nominal fees, say Azim Premji Foundation. 3. Yoga, running a non-profit center providing free or subsidized community yoga camps and teacher training programs, say Isha Foundation. 4. Medical relief, operating a non-profit hospital providing low-cost treatments like cardiac care, say Narayana Hrudayalaya. 5. Preservation of environment, a trust working to restore polluted urban lakes, say in Bangalore, like Maligawad Foundation. 6. Preservation of monuments, an organization funding the structural restoration of ancient temples or forts, say INTAC. 7. Advancement of any other general public utility, promoting sports or even trade bodies, a chamber of commerce organizing seminars for small merchants charging nominal participation fees like FKCCI. There are two key things you need to remember here. One, for the first six NPOs, commercial receipts are allowed if these are incidental to main objects. For the last one, up to 20%. Separate books have to be maintained. 2. NPOs can be formed for even multiple purposes. Say, for instance, Tata Trusts. They are into healthcare, education, sports, etc. Then we have Infosys Foundation into education, healthcare, environmental sustainability, and so on. Next, eligibility test. If you pass, you are eligible to apply for registration as an NPO. It is a two-part test. 1. The Constitution test. NPO should be legally registered in India. A public trust, a society under Societies Registration Act, a Section 8 company under Companies Act, and so on. 2. The irrevocability test. Purpose and assets of the NPO should be India-based under irrevocable trust. No cancellation or taking back of properties or funds for private use. Let's understand this with a simple scenario. Imagine an IT professional in Bengaluru sets up a Section 8 company to run a subsidized digital literacy center. She contributes a building in Bengaluru worth rupees 2 crores to the company. The company's AOA, Articles of Association, explicitly state that the institution is irrevocable and if it shuts down, the building will be handed over to another registered educational NPO. This passes both the tests, so eligible for registration. Let's compare this with another scenario. Let's say a family sets up a public charitable trust to run a yoga center. They insert a clause in the trust deed saying if the trustees unanimously agree that running the center is no longer viable, the trust shall be dissolved and the remaining funds will be distributed among the surviving trustees. This fails the irrevocability test, so not eligible for registration. Now that we have understood certain basic terms, let's talk about the process of registration. Here, I'm not gonna walk you through the step-by-step process of filing application. Instead, we are gonna focus on key aspects. Broadly, registration can be classified into two categories. One, provisional registration for new entities. Two, regular registration for active entities. First, provisional. You can apply before you commence your activities. Say you plan to start a hospital. You can file it online using Form 104. And the good part in the Income Tax Act 2025 is that this application is common for both NPO registration as well as to get approval for claiming deduction by donors. Approval will be granted within 1 month from the end of the month of filing Form 104, and this registration will be valid for 3 tax years. Say for instance, you file Form 104 on 1st June 2026. Approval will be given by 31st July 2026, 1 month from end of June, and this will be valid for 3 tax years, TY27 to TY29. Now, regular registration. You can apply after you commence your activities. Say for instance, you have established the hospital. Again, you can file it online, but Form 105. This is also common for both NPO registration and to claim deduction by donors. But there's a timeline here. You have to apply it within 6 months of commencement of your activities. Approval will be given within 6 months from the end of the quarter of filing Form 105. Now, this registration is valid for 5 tax years, that is the standard validity, but there is an extended validity of 10 years, and this is applicable to small NPOs. Now, who are small NPOs? If the total income before exemptions do not exceed 5 crores in the last 2 tax years, then such NPOs or small NPOs, they get this extended validity of 10 years. Say for instance, you file Form 105 on 1st June 2026. Approval will be given by 31st December, that is 6 months from end of Q1. Standard validity 5 years from TY27 to TY31, but for small NPOs, it is for 10 years from TY27 to TY36. Now, let's talk about income. What is the full form of an NPO, non-profit organization? No profit, no income, right? Well, the answer is not so straightforward. To understand what I mean by this, let's first talk about classification of income. Income of NPOs can be split into 3 baskets. 1, regular. 2, specified. 3, residual. Regular incomes are operational funds, permissible business income, routine donations, not being corpus donation. Now, what is a corpus donation? Here, the donor gives a specific direction to treat this as permanent capital fund. So, it is not your income. But only thing you need to remember is this has to be invested in permitted modes. We'll talk about this permitted modes in a bit. So, this regular income is usually tax exempt, but you need to satisfy 2 conditions. 1, 15% of regular income must be invested in permitted modes. 2, 85% of this regular income must be utilized. Now, there are 2 ways in which you can utilize. One is you apply, that is, you spend by actually paying for it. 2, you accumulate, that is, you set apart by filing Form 109 to spend it later. And maximum time given for this is 5 years. Again, if you decide to set apart, you'll have to invest this in the permitted modes. But if there is a shortfall, then that specific shortfall would be taxed as regular income at slab rates. To put it differently, if there is no shortfall, then regular income is tax exempt. Next, specified income. Compliance violations, related party benefits, anonymous donations, we'll talk about this in a bit. All these are part of specified income. Specified incomes are taxed at 30% flat rate. Here, 15% and 85% rules are not applicable. Next, residual. This is the balance after regular and specified incomes. Unlike specified income, residual income is taxed at slab rate. Here again, 15% and 85% rules are not applicable. Now, what is an anonymous donation? As the name suggests, name and address of the donor is not available. Anonymous donations are taxable only when it exceeds certain threshold. Now, what is this threshold? 5% of total donations or 1 lakh, whichever is higher. So anything over the threshold is taxed at 30% as specified income. And remember, this is applicable only to exclusive charitable entities. So for religious entities, these are taxed as regular income at slab rate. Now that the basics are clear, let's move to computation. For this, let's consider a scenario. Imagine here is a registered NPO running an educational institution. Total inflows and transactions during the tax year TY27. Let's consider hypothetical figures here. Student fees 700 lakhs, normal donations 70 lakhs, bank interest income 10 lakhs, anonymous donations 15 lakhs, payments routed to a trustee's private firm where no physical services are rendered 10 lakhs, rental income from a commercial building held by the trust which is unrelated to the core object 20 lakhs. Actual expenditure spent directly on running the school 665 lakhs. Let's first compute regular income. Student fees 700 lakhs, normal donations 70 lakhs, bank interest 10 lakhs, total 780 lakhs. You must set apart 15%, so 15% of this is 117 lakhs, balance 85% to be utilized 663 lakhs. Actual expenditure 665 lakhs, so there's no shortfall, so regular income is fully tax exempt. Let's tweak this actual expenditure a bit. Instead of 665 lakhs, let's consider 500 lakhs. Now the shortfall is 163 lakhs. Regular incomes are taxed at slab rate. For ease of understanding, let's say the slab rate here is 20%, so tax is 32.6 lakhs. Next, specified income. Normal donations received 70 lakhs, anonymous donations 15 lakhs, so total donations 85 lakhs. What is the tax-free limit? 5% of 85 lakhs or 1 lakh, whichever is higher, so it is 4.25 lakhs. So taxable anonymous donation is 10.75 lakh. Next, trustee disallowance, related party benefit 10 lakhs. So total specified income is 20.75 lakh. Rate of tax here is flat 30%. So income tax payable is 6.225 lakhs. Now the last part, residual income, commercial rent 20 lakhs. This is also taxed at slab rate, which is 20% in our scenario. So tax payable is 4 lakhs. So total tax payable in option A is 10.225 lakhs and in option B it is 42.825 lakhs. Now let's talk about permitted investment modes. Actually there are 32 modes mentioned in schedule 16, but here we are going to cover only 5 key modes. 1. Deposits with banks or financial institutions, that is your term or fixed deposits. 2. Government-backed instruments like saving certificates, government securities, SGBs, etc. 3. Investments or deposits in public sector companies. 4. Immovable property. 5. Units of certain specified mutual funds or investment trusts. For the complete list, you may go through the schedule. Link will be in the description. Now, are there any situations that can trigger cancellation of your registration itself? Yes. 1. If you spend on unrelated purposes, non-stated objects. Say for instance, a hospital spending on public housing unless Form 105 for modification is filed within 30 days. 2. Commercial receipts. For the first 6 categories of NPOs, if these are not incidental to main objects, and for the 7th category, if this exceeds 20% threshold. 3. If you spend on private religious purposes where benefits don't flow to the public. 4. If you register giving false or fraudulent information, not being minor errors, this can also trigger cancellation. These were some of the topics that I wanted to cover in this video. NPO being a vast topic, some of the aspects are not covered here, just to not make this video very lengthy. So if you have any specific queries, you may leave them in the comment section. And remember, to claim these tax benefits, you need to satisfy 3 conditions. 1. You have to maintain your books of account. 2. You have to get tax audit done by a chartered accountant. 3. You have to file your ITR on time. So this was all about NPOs. Hope it was informative. Thank you for watching.